Welcome to Market Masters. The Dow Jones hit all-time highs overnight and the Nifty now is just inches away from recording a fresh all-time high. This despite the Q1 earnings actually disappointing a bit. The markets are now, the Nifty is now perhaps trading nearly at 22 times 12-month forward earnings. I think the long period average at best is 20 times. Where do we go from here? And where does one invest at such high valuations? For all things macros and markets, I'm joined by Vetri Subramaniam, Chief Investment Officer, UTI Asset Management Company. Vetri, good morning and thank you very much. It's been a long time having you on the channel.
Good morning, Latha. Great to be here as always and have this conversation.
Well, first up, these all-time highs that we are trading at, does it make you elated that we have, steadily climbing, not looking back despite so many adversities in politics, in commodities, in global markets? Or is it making you nervous at highs?
Well, I think in some senses, I'm happy to see that there's a lot more domestic participation because, I've been professionally engaged with the markets for over 30 years. And I would say pretty much for the first 20 years of that, it was all about foreign investment. So I'm glad to see that there's a lot more domestic participation and wealth creation, which is happening for our local investors during this last decade. But, obviously, when prices tend to demonstrate very low levels of volatility, we haven't actually had a very significant drawdown for any significant period of time. And in some segments of the markets, valuations are looking sort of worrying. Then you do worry that, the cyclicality of the beast will reassert itself at some point of time. So that is certainly something to worry about. And I would only urge all investors not to get carried away by price momentum and to stick to their asset allocation, which is based on their financial goals.
Oh, yes, sir. Too often I hear people comparing bank deposit returns to mutual fund returns, not recognizing that the latter is not a fixed return. But to stick with the macros, the Fed statement, the Jackson Hole speech, and the possibility of rate cuts, one would think that, a double rate cut on September 18th would actually be negative news, isn't it? A rate cut actually signifies that the most conservative force in the economy, the central bank, is actually saying they're worried about markets. But here we are seeing the Jackson Hole speech as a spur to all-time highs.
Sure. In a way, I would actually say there was nothing new that came out of Jackson Hole. In a way, I think the markets were already preparing for this. There was just that slight, moment about 3 or 4 weeks ago when people, I think simultaneously worried about the Japanese carry trade and about the fact that the US economy might be heading straight into a recession. But I think the data that's come out subsequently suggests it is slowing, but it is not slowing in a way that policymakers should panic. And obviously, markets panic a lot more easily than policymakers do. I think the bigger message that I would still tell people to focus on is that era of low interest rates, when we were accustomed to policy rate settings being at zero, when we were accustomed to policymakers talking about the challenge of getting inflation up to 2%, is now gone. I think that decade is in the rearview mirror. We now need to readjust to a Fed which could cut rates, but is still unsure about getting it down to the 2% target. And therefore, the kind of policy rate that you're talking about will look very different to my mind over the next 5 to 10 years as compared to what it used to be in the previous decade.
Okay, but do you think there is still a fear that the August payrolls turns out to be very bad and we can still get a hiccup this year? Or do the other data look too good?
I think so far on balance, the US economy is slowing, but against all expectations, certainly it has remained much stronger than what anyone anticipated. And I don't really see it hurtling into a recession unless there is an external trigger now, whether this comes from politics, whether this comes from, abrupt changes in fiscal policy because of a new administration. Those would be extraneous. But I don't see the economy itself, based on the data that's coming in, heading into a deep slowdown at this point of time.
Or even American fund managers are not willing to indulge in what will happen after November 8th. So let's not get there. We'll have to cross the bridge when we come to it. Let us look at Indian valuations itself. Do you think, as many fund managers have told us, it's best to stick to large caps now that mid caps are presenting a picture of exuberance?
A good question, Latha. Actually, even before you go to the question on large caps, right, we run our internal valuation models, which run the asset allocation, schemes that we manage internally. And remember, in some of those schemes, the sort of, equivalent weightage would be a 60-65% equity valuation when we think equity valuations are fair. Those allocations have actually drifted down now to 45 to 47% equity. So effectively, we are going underweight equities relative to the range in which we operate because valuations are unattractive. So I think that's the number one message that I would point to from valuations of equities, to say you should actually be looking to cut your allocations to equity. Maybe you're overextended because of the mark-to-market gains you've had. Within that context, the small cap and mid cap space is where our valuation concerns are extreme. Very rarely in my career have I seen small caps trade at a premium to large caps, and we can go through the whole host of reasons why that is a dangerous thing to be dealing with. Within that context, there is some relative comfort in large caps. We actually published a blog about this recently. Whether you look at it from valuation point of view, return on equity point of view, the share of market cap coming from large caps, many reasons to believe that large caps provide some relative valuation comfort at this point of view. But the bigger message is asset allocation, and that's where I'd like to conclude.
Oh, okay, actually, why don't you explain a little more on this? Because it is very tempting for a market anchor to go off into financials and EMS companies and e-commerce, which I'm going to ask you, but a little more. So you think we should all be, those of us who are not tracking markets and our stocks on a daily basis, who cannot do it even for professional reasons, it's best to go to a balanced fund then?
I think so. Our push to people has been, this is a great time to go into hybrid strategies because they do sort of protect you from the risk of an elevated equity market, and particularly the ones where asset allocation is being managed by us based on certain models, and those models are telling us caution. So if you're going to approach the markets from the point of view of my neighbor is making more than me over the past 1 month, so I need to find a higher risk strategy, then hybrids are not for you. But if you're looking from the point of view that, okay, I need to have some exposure, but what's the best way to position it such that I can handle any downside risk and look to participate in equity growth over the next 5 to 10 years, then hybrids to my mind are actually a far better option at this point of time. And also note, Latha, that actually, if you look at real yields in India, they are reasonably attractive. Now, because of taxation issues, people are unhappy with bank deposits, they're unhappy with fixed income mutual funds, but the hybrid mutual fund actually gives you the best of both worlds because it rebalances seamlessly, and at the same time those fixed income returns are coming through in a strategy which is, from a taxation point of view, more advantageous.
Personally, I think that is the only intelligent thing I have done in my life. It may have been because of laziness or professional constraints. But Vetri, we have to talk about sectors. And the sector I cover, of course, more intimately is banking. It's not been the darling for the market, especially the private sector banks. Do you think it's time it got a look in? There are enough problems. Deposits are expensive, margins are under crunch, they have to put more money in bonds because of LCR, etc. But valuations-wise, is it good to look at them again?
I'm 100% with you on this, Latha. In fact, I did one of the programs on, your channel 2 months or 3 months ago, where I said, banking is pretty much one of the only absolute return investment avenues I can think of in equity at this point of time. It's done reasonably well since then. Nothing which has set the house on fire, still not really outperforming the Nifty by a big margin. But I think those arguments remain. First and foremost, balance sheets give me great deal of comfort in banks, and eventually in banks, that is what matters more than anything else. Point number 2, the valuations give us comfort both in an absolute sense as well as relative to where the market is. So that gives me comfort. Now, are there a few problems? Are the banks having to back away from some unsecured loans? We know some of them have talked about challenges there. We know about the liquidity challenges in terms of peak NIM being behind them, which was last year's NIMs. But I think all of that is reasonably well known. And I think some of these are cyclical as well. Remember, RBI at its its tightest point a year ago was holding liquidity in negative. It's gradually come to where we think it's more normalized, and there will come a point where it will start to look more surplus. So banking liquidity to myself is more important than looking at is money going to the stock market, taking away from money goes to the banks. No, it doesn't, because the money stays in the banking system. The kind of deposit may change for the bank. It could have an LCR implication for them, but the money stays in the banking system. So, let's not lose sight of that. So my mind, the arguments on banking are cyclical. That's why you're getting attractive valuations, but that is the time to go out there and invest. And this is what we said about healthcare 2 years ago. This is what we said about automobiles all the way back in 2021, when I said, how many sectors do you know in India where volumes are running lower than peak volumes seen 3 years ago? And auto's done spectacularly well since. So I would say the same for banking today. These are cyclical issues holding back the stocks, but that is really what gives you the opportunity.
Oh, that's amazing analogy. I remember all the conversations we've had about automobiles 2 years ago. Vetri, the places to avoid. I mean, look at the e-commerce valuations or the EMS valuations. Great companies, but your word on these.
Yeah, look, on e-commerce, it's always been a challenge, right? I mean, stocks some of them have done well since their listing in 2021, 22. But valuations were hard to understand. Even then, they're still hard to understand. Now, I think over there, you've got to go with the fact that some of these businesses are changing the way we consume. They're very capital efficient. They're high return on capital businesses. And the competitive environment is no longer favorable towards companies burning money. They're all under pressure from capital providers to manage their profitability and their path to profitability far better. So we still like some of those businesses. We are still invested in them. There are some of these names we bought in the IPO time. They went up, then they came down, then they're back up again. We're still invested. We are still happy to hold because we think there is a long-term story. But, are today's valuations the most attractive? Maybe not. But sometimes I would always say these businesses, particularly those that have a platform quality, they're not linear businesses. I don't talk stocks, but it's public matter. We invested in Zomato when the IPO was there. We're still invested in a very big way. Now, whoever knew that quick commerce would be a business that actually would create value for them? So I think these are some of the advantages sometimes in good managements and platform businesses that are not immediately appreciated straight out of the bat. And which is why we continue to own some of them. At what value you choose to buy them, I think that's a more subjective decision.
Okay. I'm not even halfway through my questions, but I have run out of time. I'll take a rain check from you for another day and another conversation. Thank you very much, Vetri, for some very useful tips on how to approach investment. That's it on Bazaar. We are leaving the markets pretty in the green in the first place and pretty close to all-time highs. Let's see if we can chalk it up in the next few hours. Chartbusters coming up after break.